Well, CPI is based on the Income and Expenditure Survey, a comprehensive study of household income and expenditure in South Africa. The most recent survey was a 12-month study which ended in August 2011 and recorded the purchasing behavior of 31,500 households. So, Albert, welcome to you. Thanks for joining us, of course, on WealthQuest. So, a change in methodology this time around. Talk us through that and some of the changes that I suppose we'll get into the changes, but firstly, talk about the change in methodology used in the survey.
Well, Sam, every time they go through the survey, there are a couple of different changes that come in, depending on how experience in the country has changed. For one thing, for example, in the past, this survey is based on a diary system where consumers need to write down what they purchase. In the past, the survey used to be based on the 4-week diary. Now it's based on a 2-week diary. This is just to look and to help people avoid the fatigue of, by the end of the 3rd week and the 4th week, not wanting to fill it in their diary. It's also based on a recall system where people recall some of their big purchases over the last year or 2 years. And then lastly, some of the big changes that happened is rather than being based on only the provinces, it's now based on urban areas. It's based on primary urban areas, for example, the big cities, secondary urban areas, some of your smaller cities, and then 9 rural areas, one from each province.
Yeah, I mean, I think these are the important things. Just to kind of put perspective into the debate. Firstly, when a lot of people look at kind of the CPI number, they say, well, where does this number come from? Why is this important? Why is this even important to me? And quite frankly, it doesn't feel like this is my kind of inflation number. I think my inflation number is much higher than the number I'm actually looking at.
Then below 6% is where it has kind of averaged for some time.
Yeah, absolutely. And certainly there are deviances as far as it's concerned. But just to give an indication, I mean, both the International Labour Office and both the United Nations actually have a look at a way in which South Africa actually calculates its stats. It is on an international par. So it's not necessarily that we're kind of looking at our own methodologies in South Africa and we're utilizing things that kind of are not being utilized globally. Mm-hmm. These are factors that are taken into consideration globally. Just to kind of show you what some of what Albert has been talking about, there you can just see a graphic quickly. The old basket was basically CPI for each province, whereas what we're now going to be doing is we're looking at, for each area, what we call primary urban, secondary urban, and then any rural areas. A primary urban area would literally be a large town, whereas a secondary urban area would be a small town. Mm-hmm. And now you can actually start encapsulating what the spending habits actually look like for each one of these micro areas, which becomes a lot more specific.
So Roland, I just wanted to find out what you think about this. I mean, does this ring true for you? Bread rolls, cement, power drills and eye drops are in the CPI basket. And out of the CPI basket, frozen peas, dried lentils, sinus medication, hi-fis and can't see what else I wrote. But those are some of the changes. Does that ring true for you?
In terms of my consumption personally?
Sinus medication out.
I don't know how many eye drops I use, but the amount of effort that goes into calculating this one number or the headline number, and obviously there are many other numbers that are part of this, is just incredible. And the data that has to be collated and sifted through. And what they're doing now is they're trying to obviously break it down in terms of the province into slightly more kind of demographics in terms of cities and rural areas, which will be interesting. So we're getting newer information over time that we haven't got. But I'd like to ask Albert that CPI, one of the problems with CPI is that it's so backward looking because everything is done in hindsight kind of thing. And what really drives markets is not the CPI number, but sort of the expectations of what that number is going to be. So how useful is historical CPI, and shouldn't we rather be focusing on something more forward-looking or something more market-related?
Well, Roland, I think there's probably another implied problem there, is that not only is CPI or the history of CPI backward-looking, and as Kubi said, each person's CPI is different. I, for example, am not a big fan of feta, which is now included in the survey, but I'm a big fan of coffee, so my CPI experience is somewhat different. But the CPI basket is also based on consumption patterns from 2010 and 2011. So if, for example, we sit in a scenario where consumption patterns has deviated significantly or will deviate significantly going forward, the basket might be an incorrect approximation of the way CPI or the way the spending patterns are going to go forward. I think one of the best examples of this is vehicle and vehicle cost. We all know that during the last recession, new vehicle sales dropped significantly. So a lot of fewer people bought vehicles. So vehicles form a smaller part of this basket than it used to in the past. But if the economy recovers somewhere in the next 5 years, vehicles might be a larger portion. So there is a bit of backward looking both in this survey.
Yeah.
Now, if you look at your second question, or second implied question is, shouldn't we not be looking at something different from CPI? I think the CPI number is very backward looking, and I think markets, however, tend to react a lot more on the shape of the CPI curve going forward. So one of the most interesting things we always listen to at budget time and at whenever there's a SARB review is, what is the shape of the CPI expectations going forward? What's the SARB's expectations of CPI? What are the big banks' expectations of CPI? And very importantly, how the expectations of that CPI changes going forward. So I think investors, at least professional investors, tend to make more of their choices on the expectations of CPI from these big institutions and their own expectations of CPI, and how those expectations tend to change over time.
But just Albert, before we take a look at the reweighting there, I suppose I'm just kind of building on to what Roland's saying, is that the SARB is basing their decision based on the forward outlook for CPI, but that CPI is based on perhaps a set of goods and services which are outdated, looking 1.5 years down the line. Do you know what I'm trying to say?
The problem is that it's impossible to forecast what people are going to be spending their money on. You can adjust, and you can look at the survey, and you can look at where people's spending patterns are progressing towards. However, the more you adjust your expectations, or the more you adjust your basket from the results of your expenditure survey, the more subjective the results become, and the more subjective and argumentative the results around CPI becomes. It's not that they don't adjust it. For example, they make adjustments to food. They make adjustments especially to certain things like sin taxes, or sin expenses, as people would call them, things like gambling, alcohol, etc. So they make adjustments to those types of expenditures, or at least the reported expenditures, because people tend to underreport those. So there is some subjective adjustment to the expenditure survey to get to the CPI basket, but it needs to be kept to a minimum, because at some point you need to take some data as given. You need to base your assumptions on something. You can't just sit back and say, we're going to spend 20% on food over the next 4 years, where over the past 4 years we've spent, say, 15% on food. You need to base your assumptions going forward at least on experience over the past couple of years.
You see, the other thing that compounds this argument is that we live in a country with a heterogeneous population group. So there's different spending patterns right around the country. So, hats off to Stats SA for coming up with a methodology, trying to make sure that they measure the thing as appropriately as they possibly can, and then making sure there's as widespread across the country as they possibly can. Other emerging markets, they don't even worry about CPI, they just worry about PPI. They say, well, quite frankly, it's at the factory gate. So let's not even worry about trying to measure the consumer because of the heterogeneous nature of the data. Let me just quickly show you what CPI is going to be looking like from the end of January 2013. Now, what you're seeing over there is you're seeing a whole bunch of factors at the bottom end of the screen, and I apologize for that being so small, but there's no other way that I could actually fit that on the screen. The blue bars show you the current weights, and then the new weights is obviously indicated by the orange bars. Obviously, the big one, Albert spoke about that, is transport, and you can see how that kind of weighting has changed over there. On the face-off, though, you look at this and you say, well, quite frankly, I don't see a major change here. It's going to change, but it's not going to change hugely. Well, I'd like to take you to the following graphic. These are the good people at Absa Capital. The economist there has gone and looked at CPI, and that's the old measure for CPI. You can see kind of how that looks over time, and he's extrapolated what the new basket might look like. And there you can see the new basket. You can see that's kind of marketably higher. He kind of reckons that the number could potentially come in at 0.3 to 0.4% higher than the actual CPI number that we're seeing at the moment. Yeah. Albert, here's a question maybe quickly for you. That 0.3 and 0.4% is a marked difference from what we're seeing in CPI at the moment. What are some of the contributing factors that are kind of driving that?
Well, you mentioned vehicles earlier. There's a very large reduction in vehicles. I think one of the massive increases on the other side, again, in that what tends to provide high increases over time is insurance. People tend to have been, over the last couple of years, been underreporting their insurance spend, especially medical insurance. A The reason for that was because a lot of people didn't pay it personally, it came off their payroll deductions, etc. So medical insurance or medical aid was significantly underreported. And traditionally, if you look historically, medical insurance has been a lot higher. So one of the big factors going forward that's probably going to add to CPI is the incremental increase in medical aid or medical spend. One of the other big ones is electricity and petrol. Both have seen large increases. Now there's administered prices to some extent on the petrol side, but electricity is almost entirely administered prices, cost of Eskom, etc. On petrol, it is, well, international demand and supply on oil and also currency factors. So those are some of the big changes that we can expect to see and some of the big contributors to higher CPI going forward than in the past.
So of course, a little change here and a little change there, all adding up to quite an important change, because it could mean that ultimately CPI breaches 6% this year. That's the SARB's target level, and that could have implications for interest rates potentially, but ultimately it does mean that CPI would be high. I mean, how do you interpret all these changes, Roland?
Yeah, absolutely. The consequences of this are what the markets are trying to interpret all the time. So I'm sure Albert has thought a lot more about this than me. But certainly what you're going to see is potentially higher wages being demanded, because CPI is now being bumped up for technical factors more so than anything else. A rebasing is just a once-off kind of thing, but it could have lasting effects. And then obviously interest rates could start ticking up at some point if they are to keep this inflation within the band or below 6%. So these are all major implications that the market has to process. I don't know what your views are, Albert, on the implications in terms of interest rates for a higher inflation rate.
Well, I think at the moment the expectations for interest rates is that it will at least remain on hold going forward. At the moment, it does seem to be that there's some market expectation for even something like a cut, even with the expectation of higher inflation rates. However, to most market participants, the small change in CPI, at least in the short term, is not going to be that big of an effect on interest rates, at least not that it's going to see as hiking. To a large extent, if you look at the chart that Kube put up earlier, the inflation peak comes in somewhere around June to August this year, and the Reserve Bank doesn't really make its decisions based on inflation 6 months ahead of time. It makes its decisions based on the inflation forecast more 12 to 18 months ahead. And if you look at 12 to 18 months ahead, we are at the top or within the band, even with the higher inflation forecasts, with the higher basket. Mm-hmm. That combined with the fact that the SARB has somewhat of a dual mandate and has to look at growth and some international concerns as well, means that the interest rate forecast or interest rate expectations aren't really expected to put significant upward pressure, at least not in the next 12 months, due to changes in the basket.
Albert, just also looking at the change in the basket here, some comments have been made around how foreign exchange sensitive the new basket and reweighting is. Have you looked at that at all? Is that something that will have implications on inflation further down the line?
Our basket and our inflation rate has always been very sensitive to currencies. The fact that transport, for example, the fact that administered prices, for example, now form a higher part of the basket is probably going to have at least a secondary impact from the currency side. Now, let me explain why I say that. A large part of our infrastructure spend, whether it's boilers for Eskom or other types of infrastructure spend, depending on water or water infrastructure or refinement or whatever else, a large part of that comes from offshore companies or offshore imports. If those things suddenly become more expensive due to the rand depreciating or become, what will happen is that administered prices will have to be pushed up, whether that's for water, whether that's for electricity, or whether that's for anything as simple as roads. So it will have an effect, but traditionally we have to acknowledge that our inflation has been relatively sensitive to currencies all along. I mean, we are a net importer of goods and services rather than an exporter. So our country has not really escaped the ravages of the currency, and it's always been a big player on the inflation side.
Let's bring us back into kind of the investment realm, because I mean, we're talking about stats and how the CPI basket will look and potentially what some of the implications are. Long term, it's pretty easy to kind of beat inflation. That's not a problem from an investment perspective. Most of your asset classes are inflation beating in any case. So building kind of a weather-proof portfolio.
Cash right now.
No, absolutely. Obviously cash. But making use of all the other asset classes, you should be able to beat inflation long term. That's long term. But what about the short term? Albert, how easy is it from your perspective in sitting in Atlantic Asset Management, how easy is it to beat inflation over the short term?
Well, Gubi touched on I think, of a difficult nerve there. It's very difficult to beat inflation over the short to medium term. Where we mentioned that it's easy to beat inflation in the long term. South Africa averages probably about 6 to 7% real equity returns over since 1960. But if you look at the last 20 years, there have been multiple periods where South Africa's equity returns have not managed to keep pace with inflation over a 1-year period. And there's even been a significant amount of times where inflation has outpaced equity returns, equity total returns over a 3-year period. So there have been several times where even over a 3-year period, holding equities was not a guarantee of outperforming inflation. So if you want outperformance of inflation on a relatively stable basis, you need to combine your asset classes. Now, cash will traditionally get you around about inflation, 0.5% above, 0.5% below. It's because we use cash and interest rates to counteract the effects of inflation, so cash tends to move up and down along with inflation. But it will not or should not beat inflation over the long term. Bonds will probably get you a bit closer, about 1.5% higher. But that as well, so between cash and bonds, you can come pretty close to inflation. However, if you want to go to CPI plus 2 or CPI plus 3, you need to start introducing alternate asset classes. There you'll need things like equity and you'll need things like property.
Yeah.
The problem, as we've seen now, is that equities don't necessarily correlate with inflation, or at least equities as a whole don't. So what you need to do, or at least what we at Atlantic have decided to do, is we run our mandate and we include those equities and those property shares which have a high correlation or a high effect on those drivers of inflation. Now, Sam mentioned currency earlier, we've mentioned food, you can mention property, you can mention the oil or energy. All those factors tend to be primary drivers of inflation. So if you look at where you need to invest to counteract inflation, you need to invest in those stocks which derives its profits from those types of underlying drivers.